Welcome to today's webinar on IFRS 13, Accounting for CVA and DVA, co-hosted by Deloitte and Quantifi. With the introduction of IFRS 13, the requirements for calculating complex variables including CVA and DVA remain. IFRS 13 has significant implications for all firms that measure financial assets at fair value. Today's webinar explores the challenges, risk factors, calculation techniques and concepts for measuring financial instruments under IFRS 13. Quantifi and Deloitte have also written a joint white paper on this topic, a copy of which will be emailed to all delegates. During the webinar, if you would like to submit a question to the presenters, please do so using the questions pane on the right-hand side of your screen. I will now hand over to today's presenters, Dr. Dmitry Pugachevsky, Director of Research at Quantifi, and Dr. Roman Bedau, Consultant at Deloitte.
Hello everybody, I hope you can hear me. Today's agenda of this webinar will be on the following 5 points. It will be about the challenges and implications of measuring financial instruments under IFRS 13. We will review the different fair value adjustments. We give a special slide on the funding valuation adjustments and talk about the risk factors and requirements for calculating those valuation adjustments. And at the end we have the Q&A. So IFRS 13 was issued by the IASB in May 2011, and it establishes a single source of guidance for all fair value measurements under IFRS standards. It also clarifies the definition of fair value, in general as an exit price, and it introduces consistent requirements for disclosures on fair value measurements. It is effective since January 1st, 2013. Within its scope of application, there are all transactions and balances for which IFRS standards require or permit fair value measurements. There are some exceptions, like, for example, share-based payment transactions according to IFRS 2, also net realizable value according to IAS 2. It also gives relief from its disclosure requirements with respect to plan assets according to IAS 19 and to plan investments according to IAS 26. The standard defines fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The market participants take part in an active market. That's a market in which transactions for the asset and liability take place with sufficient frequency and also with a high enough volume in order to guarantee that you have continuous pricing information. Exit price, in this definition already entered the definition of fair value. That's the price, as already mentioned, that you would that would be received to sell the asset or paid to transfer a liability. IFRS 13 gives also definitions on different markets. The principal market is the market with the greatest volume and level of activity for assets or liabilities, and the most advantageous market is the market that maximizes the amount that would be received to sell the asset or minimizes the amount that would be paid to transfer the liability after taking into account transaction costs and transport costs. So to summarize, those definitions are not entity-specific, and they are applied from the perspective of market participants. IFRS 13 also gives information about applicable measurement requirements for different product classes. For non-financial assets, you should determine the highest and best use that is physically possible, legally permissible, and also financially feasible. For liabilities and or issued equity, you should use quoted price for the transfer of an identical or similar liability or equity. And if this price is not available, and at the same time the identical item is held by another party as an asset, you should use asset premise. Otherwise, use liability premise valuation techniques. And for financial assets and liabilities, you can measure a group of financial assets and liabilities on the basis of an entity's net exposure to a particular market risk or counterparty credit risk. If certain conditions are met, one of them is that the risk management strategy is documented, the information is provided to the management, and also all assets and liabilities in the portfolio must be measured at fair value under the applicable IFRS under considerations. So IFRS 13 gives an overview of 3 valuation techniques. I mean, when the transaction is directly observable in the market, fair value determination is straightforward, but if it's not the case, you could use those 3 valuation techniques. The market approach is when an entity uses price or other relevant information generated by market transactions involving identical or comparable, meaning similar assets, liabilities, or a group of assets and liabilities. The income approach is when an entity converts future amounts to a single current amount by discounting them. And the cost approach is an entity determines a value which reflects the amount that would be required currently to replace the service capacity of an asset. That's often also referred to as current replacement cost. So valuation techniques should be selected and then consistently applied in order to maximize the use of relevant observable inputs, meaning at the same time to minimize unobservable inputs. IFRS 13 also gives indication what to do if you measure fair value at initial recognition. If your transaction price equals its fair value at initial recognition, then you have to calibrate your valuation model based on unobservable input parameters, so that to that fair value at initial recognition, to guarantee that the future measurements reflect only changes in value subsequent to this initial recognition. If, on the contrary, the transaction price differs from the fair value at initial recognition, then the resulting gain or loss must be recognized in P&L unless another IFRS specifies a different treatment, like, for example, under IFRS 9 or IAS 39. As already mentioned, IFRS 13 uses also consistent requirements for disclosures on fair value measurements and also gives a fair value hierarchy. So IFRS 13 requires a number of quantitative and qualitative disclosures about fair value measurements. Most of them are related to this 3-level fair value hierarchy, which is based on the quality of the input parameters to the valuation techniques used. So from level 3 to level 1 with increasing priority. On the inputs on level 1 are fully observable. So for example, unadjusted quoted price in an active market for identical assets and liabilities that are accessible at the measurement date for the entity. And level 2 inputs are those other than quoted price within level 1 that are still directly or indirectly observable, and level 3 is the level 3 inputs consist of all unobservable input parameters. With this, I will go to the different valuation adjustments you have to take into account. So to consider the counterparty credit risk, credit valuation adjustments, that's the expectation of losses due to the fact that your counterparty might default. You could also interpret CVA as the market price of the default option sold to the counterparty. A simplified calculation is based on the average expected positive exposure. So that's loss given default, that's 1 minus the recovery rate of the counterparty times this average expected positive exposure times the probability of the counterparty's default. For example, you're purchasing a defaultable bond from an issuer and the issuer defaults, so the defaultable bond is worth less than a risk-free bond, and your CVA is just the present value of the riskless bond minus the market price of the risky bond. At XVA desk, those numbers could be used as price or an upfront charge for an insurance policy against credit default related losses or upfront costs of hedging entire expected exposure profiles. The debit value adjustment, or if you net CVA and DVA, the bilateral CVA, this amount that is added back to your mark-to-market value in order to account for the expected gain from your own default. You could see DVA as CVA from the counterparty's perspective. If one party incurs the CVA loss, the other party should record some DVA gain. Also here you could make a simplified calculation based then on the average expected negative exposure. So your DVA would be the 1 minus your own recovery rate times the average expected negative exposure times the probability of your own default. DVA has some counterintuitive effects. Institutions record gains when the credit quality deteriorates. So that gives some strange incentives as gains only realized on default. Calculating bilateral CVA, so the netted amount of CVA and DVA has the side effect that both parties acquire then the same credit adjusted mark-to-market value.
Okay, this is Dmitry Pugachevsky. Thank you, Roman. Funding valuation adjustment. This is defined as cost of borrowing money to finance hedging of uncollateralized trades. Roman already mentioned XVA, which is abbreviation for cross-valuation adjustment, and currently it includes CVA, DVA, FVA, sometimes KVA, which stands for collateral VA. But now we will talk about this triad, CVA, DVA, FVA. So FVA is kind of the latest addition to this triad, and it should be taken into account when profitability of trade is estimated. While CVA and FVA are cost to the bank, DVA is a benefit. Quantifi was first to market with FVA calculations back in February 2012. After much debate and controversies, market finally settled on definition of FVA, which I just gave you, and how it should be calculated. And this supports our approach, which we had originally. FVA is generated by two parts, funding FCA, which stands for funding cost adjustment, and FBA, which stands for funding benefit adjustment. So what does exactly mean the cost of borrowing money to finance hedging of uncollateralized trade? Imagine the bank which has non-secure trade with some corporate, and this trade is hedged through a secure trade with maybe not riskless counterparty, but counterparty like another bank with which this bank has CSA and is fully collateralized. So when PV of original trade with corporate is positive, PV of the hedge will be negative, and there will be margin call to pay collateral on this hedge trade. To pay this collateral, bank has to borrow cash. and it borrows this at funding rate LIBOR plus SB. We'll put SB for spread borrowing, and that generates this borrowing spread generates FCA cost adjustment. When situation is positive, when trade value is negative, collateral call on hedging trade is generating cash, which earns LIBOR plus lending spread, SL. This generates funding benefit adjustment. So total FVA is netted FCA minus FBA, and we consider FVA as a cost to the bank. What's important to remember here is that borrowing spread and lending spread are quite different for banks. So, and we'll talk a little bit about this later. JP Morgan's FVA report in January 2014, JP Morgan announced earnings for Q4 2013, and therefore the first time they included FVA. It amounted to a loss of 1.5 billion pre-tax. What was interesting, JP Morgan was during investor presentation, they were giving the whole couple of slides on FVA, and there they went through definition of FVA. They explained adoption of FVA in terms which are completely consistent with definition and calculations which I just mentioned. Also, JP Morgan CFO explained how this loss of 1.5 billion could be obtained. When derivatives receivables net of cash and collateral is 50 billion, applying average duration for 5 years and spread of 60 basis points will generate exactly a loss of 1.5 billion. Once again, we have to remember that FVA is cost of funding, not of immediate borrowing of collateral, but borrowing of collateral for the whole life of the trade. So this 5 years explains that you have to look at the whole maturity of your portfolio. Of course, this is kind of simple exercise, simple explanation, but that explains how you can come up with this number. They also mentioned that they didn't take into account liabilities or funding benefit adjustment for liabilities, so therefore there was no double counting between DVA and FVA. And they of course mentioned DVA. One interesting thing is that, as Roman mentioned, DVA is controversial in the sense that when spread widens, DVA, which is benefit for the bank, is growing. So banks kind of are benefiting from their credit worsening. But FVA kind of is an opposite, works in an opposite direction. When spread is growing, it's harder for bank, or it's more expensive for bank to borrow money. So FVA basically is offsetting DVA. So that was the idea for JP Morgan to start reporting FVA. They consolidated DVA and FVA starting with the first quarter earnings, which were announced in April this year. They already lumped them together, and that was resulting in almost 200 million loss, which basically is much less than both of these non-netted amounts separately. We hope controversies are finally resolved and FVA kind of stop being really an F word. One of the kind of most heated debates was started almost 2 years ago when Hull and White published an article in Risk magazine where they basically were very critical about FVA, and a couple of arguments they were making were that first of all DVA and FVA, they refer to them as DVA1 and DVA2. Since they both depend on bank spread, then if you count both of them, it will be double counting. But current understanding, and we hope it's kind of final, is that first of all, again, FVA should be separated in FCA and FBA. DVA and FCA are completely different in the sense that DVA depends on your liabilities, bank's liabilities, while FCA depends on assets. And you probably can argue that DVA and FVA can lead to double counting, but if you calculate them using correct spread. So for DVA, we know we use most often what is used is credit default spread. For FVA, this lending spread is by no means the credit spread of the bank. You can think of this as maybe extra basis between credit and bonds or something of this nature. So if you take this, or if you use correct lending spread, there will be no double counting. Second argument, which Hull and White made, that FVA, they said, shouldn't exist because it cannot be derived using standard risk-neutral assumptions like riskless funding. This is not the first example of market incompleteness or assumptions which are too idealistic to derive some theoretical formulas. We know that even when we deal with Black-Scholes, there are price jumps, there are transaction costs which are not taken into account. This is, we believe, another example of such incompleteness or such condition like non-riskless borrowing creates an adjustment to theoretical price. So like previous incompletenesses also has to be taken into account with adjustment, this one as well. So we don't see here anything new. Another controversial issue, can you pass FVA to counterparty? Roman talked about CVA DVA and how you net them, and they together constitute bilateral CVA, and that it can be basically taken into mark-to-market. What do you do with FVA? There is no symmetrical part, like for CVA there is DVA and vice versa, but for FVA there is no. So both counterparties actually have to borrow money, and there are costs for both of them, so counterparties are reluctant to accept this cost. Some banks will still charge corporate clients for their funding. Some banks probably will absorb this. For those who charge, as the result, banks with higher funding spread, worse credit, could end up losing trades, losing clients, and become less competitive. Hedging cross VA. There's desks now, traditionally were called CVA desk. Now they are cross VA desk because it was proved practically that it's much easier to deal with all the valuation adjustment in one place in centralized form. Of course, CVA DVA is just bilateral CVA, so it should be taken together. FVA as well should be part of same, we believe, same desk or same kind of group, because you look at basically same exposures. FVA depends, as we know, on positive exposure, and the same like CVA also depends on a counterparty, on your own spread, similar to DVA. So FVA is kind of a hybrid between CVA and DVA, and of course should be calculated in same system and so on. To mitigate, so that's basically justifies and makes necessary dealing with all this valuation adjustment in one place, and dealing with them as XVA. How to hedge XVA? Here actually different parts of XVA should be hedged differently. To mitigate CVA volatility as well as hedge default risk, banks buy CDS protection on their counterparties. Recently, CDSs became less liquid, and most of the hedging is done with indices. Hedging DVA is not as straightforward as CVA. As Roman explained, DVA depends on your own spread, so to hedge volatility of this spread, it involves buying your own bonds. Of course, you cannot sell CDS protection on yourself, So another strategy is to sell protection on some basket of highly correlated institutions, for example, other banks. But this strategy backfired in 2008 when Lehman was part of this basket, and with Lehman's default, a lot of banks who sell protection on this had to pay dearly. I already mentioned introduction of XVA desks, and the fact that banks report FVA in addition to DVA offset volatility of earnings due to on credit spread moves. In addition to credit risk, XVA depends on market factors. That's basically what unifies all the component of XVA. They all depend on market factors, and they all depend on exposures, either positive or negative. Market factors which affect trades in the portfolio are interest rate, FX rate, equities, commodities, and so on. Credit if it's part of the portfolio, and hedging market risk is an important responsibility of XVA desk. These hedges are calculated based on sensitivity produced by XVA Monte Carlo model. Again, here we talk about XVA Monte Carlo model, not CVA, DVA, or FVA, because of common kind of part, which is the biggest part, calculating exposure. That's all this XVA component should be calculated in one system. And here I would like to talk a little bit about the properties of the such system and how to calculate XVA. To evaluate XVA, one needs to run full revaluation Monte Carlo, which simulates market factor and prices of portfolio of trades for each path and time slices. So here what's important, and again in the paper which Deloitte wrote with Quantifi and which was mentioned in the introduction, we talk a little bit about accounting practice of calculating CVA just by discounting future cash flows by LIBOR plus counterparty spread. That can work only if cash flows, future cash flows are all receivables, they're all assets, then maybe it's not that bad. But because future, even for this kind of trade, if you look, the current value is positive, but some paths go up, some paths go down, so you will have outcomes where at some future time PV of this trade will be negative. So it's important to, and for our CVA, for example, purposes, what we call here expected exposure, you have to look just on the positive part, so that's what you get. And also using same model, you can get positive expected exposure, you can get negative expected exposure, you also can get some other characteristic like PFE, which is used for economic capital and which is just the confidence interval of some level, maybe 99% for some future dates. This is example for a very kind of concrete trade. We consider 10-year 100 million at the money swap, interest rate flat 2.7%, volatility flat 25%, and we see this as at the money swap, so value today is 0, and value in 10 years is also 0, because when you evaluate your swap in 10 years there will be no future cash flows, so it comes to 0. But your these are paths, and these are values like in 3-4 years you can see that your swap just it's like maybe 12 paths positive, 12 paths negative. It can go to minus 18 million to plus 12 million and so on. So definitely you need full recalculation, and most important feature of this calculation becomes volatility. And that's kind of an interesting phenomenon, because interest rate swap itself doesn't depend on volatility. you can build or price interest rate swap easily from forward curve, but to calculate CVA on interest rate swap, volatility is absolutely important, and measuring and calibrating this to market volatility is one of the most important part of XVA calculation. And just to prove this, these are not paths, these are already expected exposures. Two expected exposure, one for 25% volatility, another for 50% volatility. As we expect, doubling volatility basically doubles this expected exposure. That's because this is at the money trade and this is flat rate, so basically we have this effect of kind of at the money option which is almost linear with respect to its volatility. To calibrate this volatility, you have to use, you can use historical, of course, movements of rates or other market factors, but probably the best is to use market quotes for swaptions or for cap floors, that's for interest rates, because that will allow you to hedge this volatility exposure, and that's what XVA desks are doing. Requirements for counterparty risk engine. It should be, as I explained, it should be Monte Carlo model. It should be scalable in the sense that there are a lot of calculations. You have to build a lot of paths, thousands of paths. They go to the length of portfolio. So maybe your portfolio is like 30, it has trades with 30, 40-year maturity. So that's how long your Monte Carlo goes. Then there is a lot of calculation. You have to build curve at each evaluation point and other market factors, and then price your portfolio. So scalability is extremely important. This Monte Carlo should be able to calculate all major counterparty risk and regulatory charges. First of all, this component of XVA, PFE, which I already mentioned, regulatory and economic capital. Then it should be able to produce first and second order derivatives, including cross gammas. Cross gammas are sensitivity of deltas of market delta with respect to credit moves. So it basically cross between its second order sensitivity, but you bump your market factor and also you bump your credit, and this is kind of sensitivity of market factor deltas to credit moves. Advanced modeling of counterparty credit risk, as I said, it should be able to calibrate to market observables or historical data, capture full effects of netting agreements and collateral, and this is kind of pathwise operation. That's another thing why you need Monte Carlo, and this should be pathwise Monte Carlo. Comprehensive wrong-way risk analysis. Wrong-way risk is probably a topic for another presentation, but should be taken into account for both valuation purposes, also for regulatory purposes. You also should have ability for exotic trades to run American-style Monte Carlo, where you can get future prices on some exotic trades. And it's not only current kind of XVA which you are interested in for the whole portfolio. You also need pre-trade analysis or incremental, and I say here CVA, but basically you need incremental XVA. You also need per trade attribution. You have XVA for or CVA for the whole portfolio, how you then can allocate per trade. And you need accuracy and consistency with front office pricing models. As a summary, I will start with my part. So FVA is integral part of XVA and can be successfully used to offset DVA in the sense of offsetting volatility of of your own credit spread. FVA components FCA and FBA should be calculated with own borrowing or lending spread respectively, and if you take this into account correctly, then there will be no double counting with DVA. Calculating cross VAs and sensitivity are necessary, and you have to run full Reval Monte Carlo model. Risk factors such as volatilities become very important for cross VA calculation evaluation, even if they are not part of trade valuation. And just to repeat what Roman was talking about, IFRS 13 defines fair value as an exit price. It requires the consideration of counterparty credit risk CVA and non-performance risk DVA. And let us conclude here, and let us pause for questions. Thank you.
Okay, maybe I start. You got an interesting question about the relationship between IFRS 13 and IFRS 9. I'll just read the question because I don't know if everyone can read it, the question. So the question is, one aspect of IFRS 13 is the rules for level 2 model-based valuation, specifically whether to adjust for XVL calculations. IFRS 9 covers accounting for hedge, which requires you to compare changes in projected and historic model-based value for hedged items, asset liabilities, and the corresponding hedging items, the derivatives. So effectiveness measurement and testing, that's the question about. My question is whether the combination of both standards mean that the IFRS 9 effectiveness testing should also take into account XVA. Yeah, to answer it short, yes. The XVAs should be taken into account for the effectiveness testing. The reason behind that is that the hedging instrument should, or I mean, it can only hedge effectively when your counterparty fulfills and pays his paying its cash flows. So this should be reflected in the effectiveness test, or the degree of effectiveness has to reflect this kind of potential default of the counterparty. So that's why it should be part of the effectiveness measurement. Also, the booking entries are full fair values for the hedging instruments. So the full fair value, or part of the full fair value will be CVA and DVA contributions. So this should be the base also for your effectiveness, for the amount that should enter your effectiveness measurement. I got another question here on IFRS 13. That is regarding IFRS 13, it is said that FVA is an obligatory part of IFRS 13. Not only CVA and DVA, also FVA has to be included in fair value calculations of OTC derivatives. However, I cannot find the part in IFRS 13 from which I could extract that affirmation. I would be glad if the reference to the relevant passage could be highlighted. To my knowledge, I don't know an exact reference to relevant passage, but if you consider the definition of the fair value as an exit price, we've seen a lot of financial institutions that they price FVA, so FCA and FVA, and that influences your exit price. So you should also account for this part of. So you should also use this FVA in accounting. But I will check with my colleagues, and maybe I'll find also a direct reference.
Okay, I also have a couple of questions. One of these, is there a wrong way risk in FVA? Yes, we think there is a wrongware risk is defined as correlation or relatedness between market factors and event of counterparty default for CVA or your own default for DVA. For FVA, we don't really consider default, but here we should consider relatedness or correlation between your own spread. And when we think about FVA, let's talk about FCA, like cost, which is calculated at credit spread, or some kind of borrowing spread which is close to credit. And yes, there might be a correlation between, and strong correlation between this borrowing spread and some market factors like interest rates and effects and so on. And it should be taken into account for valuation purposes, of course, but also one should be able to run scenario with this correlation, because that's how you can basically run scenario on liquidity, because using this mechanism, using this correlation, you can take a view basically what happens with a credit spread and when market factors move a lot, when there is like a crisis type situation and so on. And we all know that during this situation your lending spread grows significantly, and that can create a very, very strong kind of liquidity crisis. Another question I have, do you use for FVA the same netting set you use for CVA or DVA? The answer is no, you have to use different netting sets for each of these XVAs. For CVA you net on based on counterparty. For DVA, actually, you also first do on counterparty because it's bilateral, but then you kind of aggregate this because it's all depend on one credit spread. For FVA, you because of rehypothecation, so if you have some extra cash for one trade, you can pay for collateral for another trade. So basically you have to look at your total hedge portfolio, and if this total hedge portfolio has a negative positive exposure, then or if a portfolio of your uncollateralized trades have a positive exposure, your hedge portfolio will have negative exposure, and then you have to borrow money to against all these portfolios. So basically the answer is yeah, you have different netting set for FVA than for CVA DVA.
Okay, I also have a question here. It's said, in terms of IFRS 13 requirements for the maximum use of observable market data, what are the thoughts when entity-specific CDS quotes are not available or are illiquid regarding using real-world probabilities of default? Should these require some risk-neutral adjustment? Our thoughts on that is that so first you should look for single name CDS. Maybe your counterparty has a relevant single name CDS spread, like for example tier 1 banks, then you should use this. If you don't have access to this single name CDS, you could switch to liquid index name CDS. Maybe you can map your counterpart on an index CDS, index name CDS, and derive from that your LGD. If even that is not accessible, maybe you find some sector CDS curve, and maybe so you can map your counterparty on the sector CDS curve with respect to sector or rating. If you don't have even that, then you might quantify your credit risk with historic PDs of corresponding rating class. the last two options, so the factor CS curve and the P curve might need some adjustment of your LVD. So to answer your question, yes, so if you use sector CDF curve or P curve, you need some risk neutral adjustment.
Right, and there is another question kind of personally to me. What is your favorite model for calculation of CVA regarding accuracy of calculation and satisfying performance? Of course, for each asset class you have to use your its own model. For rates, which is probably most important because rates are part of all portfolios, at least for discounting, but also because a lot of banks have interest rate products. Our personal favorite is LMM model or labor market model or BGM model, Brace-Gattari MCL model. And the reasons are because it calibrates to market volatilities in a most natural way. To cap floors, it's almost without any kind of extra assumptions. With swaptions, you have freezing assumptions, so it also can be done pretty easily. You have your drifts, which are calculated theoretically. Either you use forward measure or spot LIBOR measure, but this is easiness of calibration. And another thing, you can easily extend this model to as many factors as you want. You can consider 1, 2, 3 factors LMM model easily, and there is nothing really which prevents you to going further. So that's our favorite. I don't know how we are doing on time. Roman, do you have other questions?
There are some other questions, but some of them I can't, or I have to check with my colleagues from the Center of Excellence, and I would answer them by email. But I think the main question for I covered. So
okay. So yeah, maybe we'll answer all other questions in the emails, and we will thank our audience, and we'll conclude this webinar. Thank you very much. Thank you for your attention.
Yeah, thank you very much.